Hello and good day everyone. My name is Femalin Kilingation and today I would like to present one of an interesting subtopic in monetary economic causes. But before I proceed, I would like to share a short story that closely related to the topic that I would like to explain today. My story is about one of my best friend's experience. She shared her experience on how to make a financial loan from a bank or from another financial institution. One of my best friend who runs a business selling used clothes with her husband through online selling told me about financial loans. So in the second year of their business, they plan to open a small business premise in Klang, Selangor. So they need quite a lot of financial resources to help fund their business. Therefore, my best friend decided to make a financial loan from a bank amounting to about 200,000 ringgit. So at the beginning of this January, the loan is approved by the bank and the loan agreement stipulates that the loan interest rate is 4%. Therefore, they has to make a repayment to the bank of the original loan amount along with the loan interest amount, which is 200,000 ringgit plus with 4% of 200,000 ringgit, which equals to 8,000 ringgit. In short, the total amount that they need to repay to the bank within a year is 208,000 ringgit, which is the amount is greater than the original one. Well, from my short story, I think everyone can guess the topic I would like to explain today, that is the meaning of interest rate. From topic 4. So what is interest rate? The interest rate is the amount a lender charges a borrower and is a percentage of the principal, which is the amount loaned. The interest rate on a loan is typically noted on an annual basis known as the annual percentage rate or APR. So an interest rate can also apply to the amount earned at a bank or credit union from a savings account or certificate of deposit, which we call CD. Well, a non-annual percentage yield, APY, refers to the interest earned on these deposit accounts. To understand about interest rate, well, interest rate is essentially charged to the borrower for the use of an asset. Assets borrowed can include cash, consumer goods, vehicles, and property. Interest rates apply to most lending or borrowing transactions. Individuals borrow money to purchase homes, fund projects, launch or fund businesses, just like my best friend, or pay for a colleague tuition. Business take out loans to fund capital projects and expand their operations by purchasing fixed and long-term assets such as land, buildings, machinery. So borrowed money is repaid either in a lump sum by a predetermined date or in periodic installments. For loans, the interest rate is applied to the principal, which is the amount of the loan. The interest rate is the cost of debt for the borrower and the rate of return for the lender. The money to be repaid is usually more than the borrowed amount since lenders require compensation for the loss of use of the money during the loan period. Well, the lender could have invested the funds during that period instead of providing a loan, which would have generated income from the asset. The difference between the total repayment sum and the original loan is the interest charge. Well, when the borrower is considered to be low risk by the lender, the borrower will usually be charged a lower interest rate. If the borrower is considered high risk, the interest rate that they are charged will be higher, which results in a higher cost loan. Now let's talk about annual percentage rate, APR. What is exactly annual percentage rate, APR? Well, annual percentage rate APR refers to the yearly interest generated by a sum that's charged to borrowers or paid to investors. APR is expressed as a percentage that represents the actual yearly cost of funds over the term of a loan or income earned on an investment. This includes any fees or additional costs associated with the transaction, but it does not take compounding into account. The APR provides consumers with a bottom line number they can compare among lenders, credit cards, or investment products. How about annual percentage yield, APY? Well, the annual percentage yield, APY, is the real rate of return earned on an investment, taking into account the effect of compounding interest. Unlike simple interest, compounding interest is calculated periodically and the amount is immediately added to the balance. With each period going forward, the account balance gets a little bigger, so the interest paid on the balance gets bigger as well. Now, interest rates on consumer loans are typically quoted as the annual percentage rate APR. This is the rate of return that lenders demand for the ability to borrow their money. For example, the interest rate on credit cards is quoted as an APR. From my short story in the beginning of this video, 4% is the APR for the mortgage or borrower. The APR does not consider compounded interest for the year. Well, the annual percentage yield APY is the interest rate that is earned at a bank or credit union from a savings account or CD. This interest rate takes compounding into account. Now let's go to the calculation of interest rate using simple interest rate formula. From the short story on the beginning of this video, the interest rate was calculated based on the annual simple interest rate formula, which is the formula is simple interest equals to principal multiply with interest rate and multiply with time. Well, the individual that took out a mortgage will have to pay 8,000 ringgit in interest at the end of the year, assuming it was only a 1-year lending agreement. But if the term of the loan was for 30 years, the interest payment will be greater and higher because we have to multiply with time. So the formula will become simple interest rate equals to 200,000 ringgit multiply with 4% multiply with 30 years. It will become 240,000 ringgit. An annual interest of 4% translates into an annual interest payment of 8,000 ringgit. So after 30 years, the borrower would have made 8,000 ringgit multiply with 30 years and it will become 240,000 ringgit in interest payments. This which will explain how banks make their money. So I hope this video has explained enough about the interest rate, and I hope you guys understand about the interest rate itself and how the banks make their money. Thank you.